Hello, everybody. Welcome to GCRE TV, and a very good morning to everybody, or good evening, or good night, depending on which part of the world that you're going to be looking at us from. Today, we're going to be doing the Money with Meg show. It's the first episode in the season 1 that we're going to be doing. We're looking forward to talking to her today about the current landscape of the commercial real estate finance world. Let's get that correct. It's the commercial real estate world, not the normal real estate world, just for everybody who's looking at us and who wants to kind of get a picture of that. And Meg is the president of 11 Capital Finance. I will, with no ado, introduce Meg to the show now. Meg, how are you doing today?
Good. Thank you so much for having me on, Gavin.
That's a pleasure to have you on. Your company is one of the most remarkable companies that we've been looking forward to working with and having on the show. Just because of your transparency and who you guys are and what it is you all stand for. So just as a little intro, Meg, if you could just tell the audience a little bit about who you guys are, what it is you do, your role and stuff.
Yeah, no, thank you so much. Like you said, I'm the president of 11 Capital Finance. We are a commercial real estate brokerage company. We're nationwide. We take a lot of pride in that. A lot of times, a lot of brokers in this industry would try to make themselves out as direct lenders. They don't really tell borrowers who they are. We're totally the opposite. We're very transparent. We just let them know, look, we're commercial real estate mortgage brokers. We work with well over 100 lenders. I honestly couldn't count this time, but we work with everyone. We work with banks, credit unions, your bank alternate stated permanent financing lenders, your rehab, bridge, ground up construction lenders, which is more the hard money side. We also do transactional funding. And we broker all types of commercial property loans.
Yeah.
So those are really all the buckets you have. You have in temporary, you have ground up, rehab, bridge. Permanent is perm. There's 2 sections. Transactional funding, something different. Maybe one day we could do a show about that.
Sure.
But we deal with all different types of commercial property types for all those deal types. So, multifamily, mixed use, self-storage, gas stations, office, retail, restaurants, anything purely commercial, obviously, that where you don't live as your home. But we also are able to do, and this is very confusing for people, especially for realtors, we are able to do 1 to 4 unit investment property loans. So if it's like 2 units, a rental, you have, 2 leases in the property, you can clearly show that you don't live there. As long as the investor is closing in some type of corporate entity, we can certainly do it as a commercial loan. It just purely has to be a commercial loan. They can't be living there at all. So we broker all that nationwide. And our gig here, of course, is to always properly assess the client's need, the real lending need. And most of the time when clients come to us, it's because their bank has said no, or the lender that they go to has said no, or maybe they're just a new investor and they have no idea where to go and how to navigate the commercial real estate lending landscape, because it's a crazy business. I actually have a saying for this business. I actually call this business its most unprofessional professional business. And one day we could probably do an episode about that too. But it's a lot of heat, a lot of unprofessional people in this business. So when you get a hold of someone who's really professional, you got to keep on to them. But that's really when borrowers come to us, because they need to navigate this whole entire landscape and really get their deal done. And I always tell people, obviously my goal is to get the borrower the best rates and terms. It is, but my goal here is also to get your deal done. It's to get a deal done. I mean, there's several times I've given people quotes and said, look, this lender is 1 interest point higher than the other one, but you're telling me you need to close in 30 days. And I know this guy over here who has the lower interest rate isn't going to get it done in 30 days. So can you get an extension from the seller? If you can't, look, we got to get it done. So that's just kind of what you have to do when you're experienced in this business. I've been in this business since 2011. So basically 10 years I've been in this business. And, for me, the market collapse in 2008 happened. I got in 2011, which really was not a great time to get involved. Previously, I was a realtor in the state of Pennsylvania. I had a lot of deals blow up on me due to the financing, which drove me into learning about financing and then eventually jumping ship and getting into financing. But really lending for me, commercial real estate lending didn't take off to 2013. That's when you really had not just your banks coming back and really lending on commercial deals, but you had your secondary market lenders coming back. When I mean secondary stated lenders, lenders that are doing permanent financing loans but don't need tax returns. They're really just underwriting based off the debt to income ratio on the property, which they call debt service coverage ratio, DSCR. That's when lending really started coming back. I was consistently closing loans, and I knew this was going to be a business I was always in. So I know our topic today is, the landscape of commercial real estate lending, during COVID right now, which we are in. It is November right now. I can't believe it. It's November. But I just want to touch on real quick what everything was before COVID. Like I said, lending really didn't come back for me until 2013. And I think a lot of mortgage brokers and lenders that were in the business probably felt the same way. That's when, really just deals were consistently closing. Prior to that, lenders found commercial. Now, again, we're only talking about commercial real estate lenders today. That's it. Commercial real estate lenders. So commercial real estate, that is, it's a loan backed by real estate. Sometimes people will call me and say, well, can you do a commercial loan for me? And, I want to buy a business. I'm not an expert in business loans. That is a commercial loan, but it's not backed by any real estate physical asset. So what we're talking about is commercial property backed by a physical bricks and mortar asset. That's what we do here at 11 Capital Finance. But again, pre-COVID, 2013 to, really March when this happened, LTVs were coming back. LTVs, I wouldn't say they were crazy like prior to 2008, which is why I always felt like the business was going to be secure and stable, because my predecessors have always told me when these LTVs start getting too high, you have to watch out. We're going to have another market collapse. It really wasn't like that. Everyone was very conservative. People really were not going past 75% LTVs. I mean, lenders were not going past 75% LTVs on commercial properties, even on 1 to 4 unit investment properties. Max LTV I've ever seen in this business on a permanent financing loan has really been an 80% LTV. So LTVs were still very comfortable, but people were able to deal with them. And I think borrowers really understood everyone wants the highest LTV, but we have to put this money down so that we have skin in the game and make the lender feel comfortable. Everyone kind of understood that. Prior to COVID, retail was extremely easy to get funding on. You could, as long as the borrower had good credit, decent credit, I'm talking like 650 mid-score or higher, you could get any type of retail shopping center funded by anyone, as long as it was pretty much at least 90% occupied or not for a permanent financing loan. Restaurants prior to COVID, restaurants have always actually been difficult to get funding on. Lenders, commercial real estate lenders really want to fund, your big chains. That's what they're looking to fund. The mom and pop restaurant was still always difficult to get funding. So you can imagine now the poor mom and pop restaurant, we're going to get into that a little later, how that they're dealing with it now. But restaurants were always a little tough. And then, FICO requirements, like I said, prior to COVID were looser. You could, banks, credit unions have always wanted a 680 mid-score or higher, but your secondary market lenders in terms of permanent financing, they could deal with a 650 or higher, maybe a little lower if there was like a story behind it that made sense, maybe a death in the family, a divorce. You just got to get your borrower to write up a letter of explanation that makes sense and to prove how they dealt with the issue. They're getting over it. Medical issues, medical bills, everyone kind of understands that. Okay, March hit. That's when COVID happened. So what were the first kind of programs to go? Really, that's what I want to talk about right now. So first, to start off, when COVID hit in March and everything started shutting down, schools, all types of non-essential businesses, even maybe some businesses that some would say are essential, it was a free fall in lending. It was scary. And for me, I do a lot of course, loan placing here, loan processing, walking the borrower through the whole entire process. I mean, I had at least 50 clients that one day this lender's out of business. So I'm scrambling to try to replace their loan with another lender that does a similar loan. Even though the interest rate might be higher or something, I have to get this person's deal done. Hour later, that person's out of business. When I say out of business, stop lending. We're halting lending for now. That's what the lenders are saying. There's no foreseen future of when we're going to come back. Just right now, it's done. So it was a free fall. It was really scary. Appraisers, a lot of appraisers actually refused to come out to properties. Everyone was scared. Everyone was staying home. Then we were on lockdown. Everyone had to stay home. So if you can't get a property appraised, can't do a real estate deal. So it was a free fall. It was really scary. There are lenders, though, that did stick around, and I'm going to get into that too. But I want to just go over the first programs that really went in commercial real estate lending were your Airbnb programs for rental properties, investment rental properties of 1 to 4 units that real estate investors are using them as Airbnb short-term rentals. Those went right away. Lenders didn't want to lend on them. Ground up construction went away very quickly. And again, like I said, retail was always easy to get a loan on, but all these retail shops shut down, so you couldn't get retail funded. Restaurants had no chance. They had no chance. So that was pretty gone very quickly as well. Another thing that was interesting to me too was even mixed use properties, because you have a storefront in the front and then you have 2 or 3 apartments up top. I had a loan where it was a mixed use property, 3 apartments up top, and the bottom was an ice cream shop. I had that deal go through a whole twist and turns, and the property actually overappraised before COVID hit. We're coming to a close, and the lender really threw me for a loop and said, well, because it's an ice cream shop in the bottom, it's a high contact business. What if they go out of business and they stop paying their rent? And they didn't deny the deal. They just drastically cut the LTV severely because the ice cream shop on the bottom was considered a high contact business to them, and it really threw my deal for a loop, and the borrower ended up backing out. So this is a crazy business in general. What people don't understand about commercial lenders is no one is obligated to give you a loan. This is not residential lending. This is a business decision from the lender, and if they feel something is off about the file, or if they just don't even like your attitude, they don't have to lend to you. So it can be a heated charge business, but that is just the way it is, and lenders are going to make decisions, very quick and vast decisions when things happen like this. So too, what did most commercial lenders stay in the business do? The ones that did last? Lot of stuff. There were ones that did last. So, what they did was they hired their FICO requirements. Everyone went to 680 or higher. Some even went to 700 and higher. And that's always where banks and credit unions have been. But I'm saying secondary market lenders, hard money lenders, they hiked their FICO requirements as well. They cut LTVs. Some lenders were doing like 50% LTV. That's a lot of down money if you're doing a purchase. They escrowed payments very quickly. So if you're doing a purchase or even a refinance cash out, they wanted to escrow 6 to 12 months of mortgage payments. So, you could see how that could really slow. They're making it really hard. They're making it really hard to get approved because, if you're doing a purchase and you're only getting a 55% LTV, and then you have your closing cost, down money, closing costs, then you have to escrow 6 to 12 months payments. That's just a lot of money to put out. If you're trying to get cash out of something and they're escrowing 12 months of payments, there went a lot of your cash out. So a lot of our borrowers were just like, well, why am I even doing this now? They're right. Why are you doing this now? Why don't we wait a couple months and see what happens and see if the market opens up, and then maybe let's start this back up again. Raised experience requirements. There were some ground up and rehab lenders that did stay in business, more rehab than ground up. They raised experience requirements. You have to have done so many fix and flips in the past 2 or 3 years. Can't be a newbie to the business anymore. Areas where there were a lot of rioting and stuff. Commercial lenders have never liked high crime areas, but New York, I still have problems getting deals done in New York, and it's November. Hopefully, I believe the rioting there is done. But the rioting, which isn't really about COVID, but we're talking about, that also made this even harder. Leases. Another thing they did, leases, they want to see leases going for 6 to 12 months, extending after closing. So a lot of that's very hard to do. You got to understand, when someone's purchasing a property, a lot of times the current owner is not managing the property that well, and that's why they're just going to give the new buyer a discount, just to take it off my hands. You manage it right, and they might not have 1-year leases with the client or 6 months. Maybe they're month to month. Maybe they were such a sloppy bookkeeper they didn't have leases at all. So it's making it extremely hard for a new buyer to come in, and banks and other lenders are saying, well, we need 6 to 12 month leases. We need to know that they're going to pay you. Well, I'm not the owner. How am I supposed to get leases with someone if I don't own the property yet? So that's been difficult, but there are kind of ways to work around that. Another thing they did, COVID questionnaires. Lenders now that were still lending during COVID, they actually made the landlord fill out a questionnaire about all their tenants, what they make, who they work for, are they still employed? They wanted to know that the tenants could still pay. They were even verifying that the the rent was going into bank accounts. They would actually ask for bank statements and say, circle all your rent deposits, or give us copies of the canceled checks showing that you're getting rent, which lenders typically did do prior, but now it's standard. Now everyone's doing it. Not everyone did prior. So what lenders did stay in business throughout COVID, when COVID hit, multifamily was still really popular. Everyone loves multifamily. Every commercial lender loves multifamily. So anyone lending on multifamily, in terms of like a government-backed program, like you have your Fannie and Freddie FHA programs, they were still in business. SBA lenders were still in business. All the SBA does have a requirement they cannot lend to businesses shut down. That is one of their underwriting rules. So obviously, if people were shut down, they couldn't do that. We did have a couple banks and credit unions that did stay in business. They never stopped lending, although, like I said, they made it hard. They made it really hard. We had hard money lenders that stayed in business. I would say the lenders that stayed in business the most were the lenders that actually have their own money. A lot of lenders out there will borrow money, get lines of credit from banks, and then they'll lend that out at higher interest rates. But if the bank stops lending, now your money you lend out gets cut off. So lenders that raise their own money and actually have their own money in their bank accounts through investors or whoever they are getting their money, they're the ones that stayed in business. I actually did a really good hard money refi cash out loan during COVID. A guy had an awesome property in Nashville, Tennessee, an awesome condo worth $2 million. He won $1 million cash out. I had a hard money lender that would do it, and they got it done. And I know the reason they got it done was because they had their own money in their bank accounts. All right, so I am going to move on to kind of just real quick. How did we react when COVID did here as a brokerage shop? I am the president of 11 Capital. I'm in charge of all of our commercial real estate loans. I'm in charge of making sure our reps' loans close so that they put money in their pocket, and that's can be a stressful job sometimes because I'm very loyal to all of our reps and people that originate loans for us. So when the market's in a free fall, I have to think quickly, and I have to make sure we're moving in the right direction so the reps can put money in their pockets and support their families as well. So we quickly moved. We actually participated in the Paycheck Protection Program loans. The fees were not huge. They were very small loans, but it was something. I had to do something to make sure the reps were making money because commercial real estate was in a free fall. And again, if the lender was still around, they were making it very difficult to get approved. Some borrowers were just getting frustrated and walking. I get it. We did move into business loans. I have never been a fan of business loans, but we did slightly move into there. The problem with business loans is people don't understand. If you don't have a business that's producing positive income, you don't qualify for a business loan. Now, what happened in March? Everyone stopped. Everyone was making less money. Everyone was losing money. So how many businesses qualify for a business loan? Not many. So that was just something we explored, didn't really go anywhere. I focused us on commercial real estate programs that were backed by the SBA or the government or something like, one of those government agencies. Those were programs that never went away. You had, again, your multifamily Fannie and Freddie FHA programs. They never went away. Now, did LTVs maybe creep down a little bit? Yeah, they did. But you got to understand, part of that loan is government backed. So lenders feel a little bit more secure lending money out for that, because if you default, at least they're going to get half of it back, or whatever percentage the government's going to back. It's usually, half, 40, 50%. So we did focus on SBA loans. There's a lot of essential businesses that were still in business that needed loans. I even ran a couple deals by the SBA of liquor stores, which is unique because SBA really doesn't like any type of, they're not into businesses that, I want to say, like sinful businesses, like no adult entertainment, no alcohol, no medical marijuana or legal marijuana. They don't really like that, but they were open to liquor stores because they were open and people were buying, so that's where I moved us. We also fell into, now that we're doing recently, this program came out about a month and a half ago. There's a new express relief funding program that brokers are allowed to broker. It is not the Paycheck Protection Program. It's not EIDL, which is the Emergency Disaster Relief Program that's always been around. It is pretty much an extension of the EIDL, but you don't have to submit financials. You don't have to submit financials at all to qualify for this program. You can get up to $150,000 if you qualify. But again, EIDL is full sets of financials being submitted, so there's a difference there. One day we can do another topic on that. I have a bunch of topics we can talk about. Okay, so then let's get into what's the landscape now, and then we can wrap this up. So the landscape now is, we're in November. Airbnbs are slowly coming back, actually, which is good. Not many lenders are doing them. We have like 2 bank alternate stated lenders that are doing them right now. I have called several banks across the country because we are nationwide. We broker loans nationwide. Banks and credit unions to see if they would do them. A lot, and again, you to trust that bank's prerogative how they feel. A lot of banks don't want to touch them right now. They're still scared where, like, maybe if the curve goes up with COVID, people aren't going to be going to these Airbnb properties because you have people coming and going in and out of these properties. They're high contact properties of, people coming and going. So some banks are not down for it, but other banks have said, we're not going to do it right now, but or they would consider doing it right now, sorry. But we need, of course, full sets of financials, as banks always do. We need to see that the borrower is making enough money on their tax returns to not only pay for all their own debts, but they're going to have to show that they can support this mortgage as well, as we're anticipating they might not be able to rent it out, So it's really just kind of how that lender feels. Prior to COVID, there were a ton of Airbnb properties and, property loans. And what happens if someone had a 1 to 4 unit investment property that was a rental and it wasn't rented out? What appraisers would typically do is just go off the local market rent. There's a 1007 form they can fill out. They would go off the local market rent, determine what that is, and the lender would use that to calculate their debt service coverage ratio on the property. That stopped once COVID hit. It just stopped. Nope. It is slowly coming back, but lenders are very, very big now. They want leases. They want 6 to 12 month leases that extend after closing on the property. And I know I'm in this every day. Real estate investors are like, well, just because I have a lease with someone doesn't mean that the tenant's going to pay me. You're right, it doesn't. But that's what the lender wants, So it is what it is. This isn't a negotiation. Lenders it makes them feel safer. And again, that's what they want. And a lot of real estate investors always say to me, but I can make more money, Megan, if I rent it out as an Airbnb. Why would I do a 12-month lease on the local market rent when I can make thousands of more doing it this way? I get it. Okay. But, do you want to get the deal funded or not? Or we can try that, but I just have less options, so we're full of options here. That's how we get deals done. All right. A little bit more today. Retail is still extremely, extremely hard to get funding on. And I feel horrible about this because I have a lot of clients that have retail properties that need to purchase them or refinance them. Even if it's 100% rented right now, I have a couple retail deals, honestly, right now that I'm having a little bit of difficult time placing with some of the banks, actually, because they want a bank loan. It's 100% rented. And then lenders are like, we're just not sure about it. We don't know what's going to happen. Although I do have a couple banks that are willing to take a stab at it, but they're lowering their LTVs. They are lowering, banks are typically like 75, 80%. They're lowering them like 65%, and they're actually raising their interest rates a little bit on investment properties that are not commercial or occupied because they feel they're more riskier. Restaurants, I feel really bad for restaurants. They're dead. There's very little financing right now on restaurants. Even the ones that have reopened up, it's really a hit or miss. It's a 50-50. A lot of lenders, I've been on conference calls the past couple months, a lot of lenders are anticipating 50% of restaurants will die. So they don't want to lend on them now. They want to wait to see what happens and see if they survive. Ground up construction is definitely coming back. It is much easier to get a ground up construction loan on a 1 to 4 unit investment property. So a single family home, condo, townhome, 2 unit, 3 unit, 4 unit. That's what I mean when I say 1 to 4 units. Commercial ground up construction, a little harder to do right now. If there is a residential aspect to the property, such as like a multifamily property or a mixed use with a lot of retail on the bottom, resi up top, easier. If you're just trying to build a stadium or whatever you're trying to build, a little harder to get done right now. FICO requirements have eased a little bit, but most lenders are still at a 680 and higher that they want in terms of permanent financing. Even hard money lenders are. We do have a couple lenders going down to like 650, 620 in terms of hard money. But it lacks a little bit, but it's still there. Experience is becoming a little relaxed as well. Like I said, experience requirements went up. And when I say experience requirements, it's really, for rehab loans and ground construction loans, experience building? Do you have experience building something and being the owner on title to it? So when COVID hit, that was gone. You needed a lot of experience. Now we do have rehab lenders that are lax again. They'll lend to new rehabbers. Now you still have to have good credit though. You still have to have 680 credit, or higher, which is just going to help the file, help it get closed. Escrows have definitely relaxed as well. It's not a full 6 to 12 months. We have some lenders not escrowing payments at all anymore, which is great. Some just escrowing 3 months. So that has definitely relaxed. And then again, you still, this is not in terms of commercial real estate, but you still have your EIDL programs. You do have your express relief funding program that's out now for small businesses. And the great thing is real estate investors can apply for these programs. Previously, for the Paycheck Protection Program, it was a little hard for real estate investors to apply for that and get qualified, but you can for the Express Relief Funding Program. And if anyone needs to know how to apply for those programs, Gavin's going to let us know at the end. But really, Gavin, that's just kind of my spiel. One thing I didn't mention, though, was when COVID hit, obviously everything was a free fall and it was scary. But when commercial lenders did start coming back, or they did stay in business, some of them were raising their interest rates, which I know is odd for people because in the residential world, interest rates were just plummeting and going lower and lower. Commercial and residential interest rates are two polar opposite things. You want people to keep buying residential homes. You want people to have homes. That's something totally different. And again, we don't do residential lending here. But in commercial, when the economy becomes riskier to lend, interest rates don't go down all the time. Maybe some of the banks were lowering their interest rates a little bit, but most of the commercial lenders out there were not. They were raising their interest rates. They were making it harder to get a loan. And as I've gone through COVID, as I've been dealing even with some banks, because again, we work a lot with secondary market lenders that are not banks, non-bank lenders. But even if I've been working files through COVID with banks, again, they're lowering their LTVs now on investment properties. I have a retail one right now. And in fact, 2 of the stores in there are food businesses. So what a hard deal to be brokering right now. But they went from an 80% LTV on me at a 3.8 interest rate to a 65% LTV. Now the interest rate's 4.5. They're seeing this property to them is more riskier, than it was. So I have seen interest rates though slowly coming down though. They are slowly coming down, but I would say, a little bit after COVID, they were up and thank God they're coming down a little bit now and restrictions are relaxing so we can get more deals done. Us as brokers can make money and our borrowers can get their deals done as well.
Cool. That's really a lot of information you passed on there, Megan. I appreciate it a lot. I've been making notes as we've been going along. Lots of things to consider for the market, especially with what's going on now. We still don't know what's going to come out of this, especially with the whole political landscape as well in the US.
Yeah, I
don't think that's going to add to it right now.
I didn't even want to make that a bullet point because I was like, I will go way over if we could get politics into it. So a wise person always told me, you never talk about religion and politics with people you care about. So
exactly. Well, exactly. Well, I mean, it must be taken into account right now with everything that's going on in the current climate. So I just made some notes here. So we'll just cover a couple of the things. When you were talking about pre-COVID, it was still difficult sometimes to get lending, but it was much more possible. The requirements for it, like the credit scores, from what I understand from what you're saying, the requirements for it has gone up, and also people want to see more financials, more bank statements, more proof of income, and all those things, which is kind of weird because I think the requirements for banks or for lending is going up higher now, even though without a COVID rule. I think it would always remain like that because of the uncertainty of what could happen and then collapse markets just overnight, as we saw happen.
Mm-hmm.
Also, you mentioned that no CRE, no commercial real estate lender have to lend unlike the residential. I thought that was quite cool. I've never heard that before. But it's a requirement, but they're, as we would say almost in Britain, they're a bit snobby. They can look at you and think, well, okay, we don't need to do this, But in residential, it's more of a requirement that they have to.
Well, residential, you can't discriminate people in residential lending. I mean, even if for example, if someone has a felony, you can't discriminate them from buying a residential home. And commercial, you can all day long. Lenders do that all the time. Yes. Especially if you have a felony related to some type of financial crime, that's going to be a no-go with anyone.
Yes.
So commercial is just literally a lender could wake up on the wrong side of the bed that day and just say, I don't want to lend on any more retail buildings or mixed use.
Yeah.
Our portfolio is too full of those, so we're just not going to do this loan anymore.
Yeah, no, I thought that was interesting because I never really knew about that. I thought, wow, that was quite interesting. I think everybody should make a note of that.
And that's why it's important to have a good broker, because as you know, being a mortgage broker, if I have a lender that I'm getting that sense for them, or they come and tell me that, I have to have a very quick backup plan for my client. You know, my clients have to get their deal done. So you can see these deals become heated and stressful, and you just got to learn to bob and weave and understand the business.
No, definitely. You said FICO requirements have gone up higher over secondary lenders, especially. So the bank's always going to have the FICO requirements, but now secondary lenders, which is like your, as we would say, your hard money lenders, right? That's also gone up.
There's still a group of permanent financing lenders out there as well, where you don't have to go hard money yet. I call them bank alternate lenders. A lot of people call them non-QM lenders.
Yes.
The point is, it's still a permanent financing loan. A permanent financing loan is it's a loan that's amortized over 20 to 30 years, and there's a principal and interest payment. Hard money lenders are only interest-only payments. But yes, all of them have raised their FICO requirements. You know, if you have under 600, and when I say FICO, I mean credit requirements as well. In the business, we use the term FICO and credit interchangeably. We mean the same thing.
Yes.
Commercial lenders always go off your mid FICO score, your mid credit score. So if you have a 620, a 630, a 640, they're not taking all those three scores and dividing by 3. It's just actually the one in the middle. So sometimes people have scores that are all over the place, but yes, they have raised them. And if you really have a mid score under 600 right now, it's
good luck.
Yeah, I know. Maybe get a. People always say, "Well, I'll get a credit partner." It doesn't work like that in commercial. I don't know if it works like that in residential, where you can just have someone co-sign for you for a home.
Yes.
I don't know. Commercial, it doesn't work like that. You can't just use someone's credit. They have to be part of your entity. If they're not part of the borrowing entity, at least 20% or more. But if you're using their credit, the lender is going to want to see they're at least a 50% owner. If they're not part of your company that is getting this loan, that's going to own this real estate, you can't use their credit. So you can restructure your company. You could add them to your operating agreement. You can make them 50% owner. If that's what you have to do to get it done, that's what you have to do.
Yeah, it's almost like a personal guarantor. In the residential world, they would call it. That's what we would be doing. So you also mentioned that raise requirements, experience requirements is now a big part of that, which was never part of the picture. So if you're actually doing a refurb work or something like that, or a flip, which probably really doesn't happen that much in the commercial world. I can't see it always happening, but experience is required right now. The rioting areas is also one that you mentioned, which is quite interesting. I don't know how much people know about that, but definitely if there's riots happening in your area, probably wait for the riots to calm down if it's not a non-riotable area.
It's still very hard to get a loan done in New York. We have some lenders doing it, but our main banks and credit unions that we always worked with in New York for years are still not lending. And that was since March. Now, I do have secondary market lenders. I do have hard money lenders lending there. But, some people want a bank loan. They want that low interest rate. In terms of the rehab loans, though, just so you know, we do a lot of fix and flip loans here of 1 to 4 unit investment properties. So, someone could be fixing a single family residence, a house, and then they're going to flip it and sell it, or they're going to refinance. So rehab lenders and ground construction lenders have always had experience requirements. They want you to have ownership, construction experience and be on title, but they just went way up during COVID. And then you always do have some lenders out there that are willing to take a stab at a new rehabber or someone who's doing a new ground up construction loan. But now that is very, very few that are going to take a stab at someone during COVID that's, building a new property ground up that has no experience doing this.
Yeah.
Very few.
No, definitely. And the last point that I touched on, which was leases must be longer than 12 months now, ideally. They don't want to see anything less than that, which makes sense. I mean, it gives a sense of security for the lender, knowing that there'll be an income coming in. But we also made the point, what's to say that the person have a 2-year lease and they don't pay the rent after 3 months?
Exactly. What it does.
It's all risk-based.
it's just the lenders just want to see it. It's part of the commercial real estate lenders just want to see it. It's part of their underwriting requirements. It makes the underwriter feel warm and fuzzy. And you know why they're doing that is because obviously the person who's the one rubber stamping this loan at the bank or the lender, whoever they are, they want to keep their job. Everyone wants to keep their job right now.
Yeah.
So if that person defaults on their loan, they can go back to their boss and say, look, he had a 12-month lease. Like they had a 12-month lease.
Yes.
And they showed us that they paid 3 months prior with bank statements. So how was I to know this was going to out?
It's almost a tick box exercise, as we call it.
But on the other hand, again, I'm a broker, so I'm always in the middle of this. I understand what the borrowers are saying. No, you're right. It doesn't mean the borrower is going to pay. It doesn't. Yes. And so let's not bring that up to the lender, because now if I say that, they might say, well, then let me escrow some payments, some mortgage payments. So let's just give them their 6 to 12-month lease that they want to see, and move on. And I feel bad too, because a lot of real estate investors have gotten burned by doing 6 to 12-month leases with the wrong people. And now this person's in their, their investment property, destroying their investment property, and they can't kick them out because they're in the lease, So there's a lot of back and forth, but the key to getting deals done right now, being a good mortgage broker, is you have to be on the ground floor like I am doing this every day. You have to understand the lender's underwriting requirements. It's so much more than, okay, this lender can do this. Yeah, there's dozens of lenders that do permanent loans, rehab loans, bridge loans, ground-up construction loans. There's hundreds that fill in each bucket. What is each lender's underwriting requirements, and where can I actually get this deal done? And that's where the real skill in this business comes from.
Yes, that's cool. So let's touch on the individual topics now. So you say Airbnb is slowly coming back. It's not as way it could be, but it is gradually coming back right now. Ground up is still a big thing. Everybody's still kind of, and I said they need more experience and they need more a FICO requirement. Retail still a huge no-no. I can imagine in New York nothing is getting done still. Restaurants, well, we know that's pretty much 50% of them are going to be dead. I don't know. I feel sorry for the people in that world, but I think if they use a little bit of creativity, they could probably get around a couple of things and really sort of survive at this and water this out, as we would say. Commercial is a bit difficult when it comes to get in right now, but if it had an aspect of multifamily in it, it could work.
Everyone loves multifamily. Actually, I was on a conference call with a lender about 2 months ago, just giving a presentation, and he's been doing presentations nationwide. And he actually told me multifamily is the only, he's getting from all the conferences he's on, so hopefully this is accurate, but I do believe this. He said multifamily is the only commercial property that is performing in every single top market right now. It's the only commercial real estate property is actually performing, meaning, it's bringing in its full potential. Rent, landlord, owners of those properties are still able to make their mortgage payments. I'm sure people that have other commercial properties, such as retail and stuff like that, if their tenants' businesses are shut down, they might not be getting their rent. They might not be able to pay their mortgage payments. So that's what he meant by that. It's performing, which is why all commercial lenders want to lend on it. That being said, there's also this other aspect of lenders saying, well, are the tenants paying? Everyone still needs somewhere to live, so hopefully with the government stimulus money and hopefully with unemployment, people are doing the right thing with it. And still, I think that's the thing you're going to pay for, hopefully first. I mean, obviously food, water, clothing is very important as well, but so is somewhere to live. But, now I don't believe, I know certain states, and it might even be nationwide, you can't kick people out. So there's a big struggle with this, but
I think that went on globally. Even here in Switzerland, landlords was told that they can't kick anybody out during this pandemic because the government is going to give relief to them and X, Y, Z. But I think it almost becomes like a Section 8 clause, isn't it? Where the government would pay the money, but then it goes straight to the landlord instead of going to the tenant, I think.
Honestly, that's how it should be, in something like this. But that's, these government-backed multifamily programs that I spoke about earlier, the government loves Section 8 housing, just so you know. They'll even now, which is going to be rare prior to COVID, even during COVID, the government will lenders will actually provide a 90% LTV on certain multifamily properties. The loan amount has to be $1 million or over. So you're pretty much a large multifamily property. But if the whole property is Section 8, you have lenders that will do up to a 90% LTV. And again, the government is insuring a percentage of that to the lender, typically 50%. So if that borrower defaults, that lender's only out, 40, 50% of what the loan is. And again, the lender gets to, of course, foreclose on the property, which not they want to do, but they should be able to recover that money. So just so you know, lenders and these government-backed programs love Section 8 housing.
Yeah, I know. I learned about that a little while ago, and I was like, that's actually quite a smart idea if you took 50% of your property and do it like that, just to be safe. But that's for a topic for another day. We don't want to go into that right now. And then you said small relief programs. Real estate investors can actually apply for that as well. It is open to, I don't know how many people are aware of it, but
maybe we could do a topic on that, the difference between the EIDL, which is emergency disaster relief loan, and the express and now the new express relief funding program. They're two different programs. But the express relief, if Gavin, I know you're going to tell people how they can apply for loans. That can happen with the information you're going to give them. Real estate investors can apply. Anyone can apply. The key is you cannot have already received an EIDL loan. If you already received an emergency disaster relief loan from the SBA, you cannot apply for the express relief. Max funding is $150,000, but really cool program, and you don't have to submit financials. This is just a way to get money into small business owners' pockets, which could be real estate investors, very, very quickly.
Yes. No, I'm sure I'll put some notes on that. So for anybody who's looking, if they want to get in touch with Meg, we'll have on the website, globalcretv.com. We'll have a separate tab on the menu for just finance deals. You could click on there and you'll be able to fill out a form, and then Meg would be able to get in touch with you directly from there. So if anybody following this show wants to get in touch with Meg, there'll be a separate tab there for them. Anybody, globalcretv.com, and we'll be able to make that available on the description on this link and via all our social media channels as well. So if anybody needs it, please feel free to reach out to Meg. Meg, that was a really good show today. I mean, is there any closing remarks you have for us before we close off the show?
Really, no, because I'll talk for another 30 minutes. So, but really what I just want to say too is, these are scary times, but there are ways to get your commercial real estate loan done. So Gavin, you also have that, 11capitalfinance.com / your abbreviation. With GCRE.com. If people go to that, I don't know if you can put that website up, but if they go to that and they scroll down on your website, there's actually a contact us section. You just put your name, your contact number, a little message. If you submit that on Gavin's company's website, we will be in touch with you and of course, answer all your questions, let you know what's going to be the best course to get your deal done.
Yeah. All right, cool. Meg, it was a pleasure to have you on the show today. I look forward to doing the next episode 2. Next week, same time, guys. Thursday at 10 a.m. Eastern time. And that would be 4 p.m. Central Europe time here. But Meg, I appreciate the time, and I look forward to connecting with you again soon.
Of course. Thank you so much for having me on. I appreciate it.
Cheers.
Bye.